Interest rates are rising. No, equities and stocks are overvalued. You see the inflation numbers? We got tariffs, we got trade wars. We got a national debt that is going through the roof. Lord knows what that guy's going to say next. So given today's markets, yeah, I want to invest long-term and be optimistic. But given today's markets, yes, you're right, I need growth. But given today's markets, what is somebody supposed to do? Hey, welcome to the Retirement Answer Man Show. My name is Roger Whitney, your host. This is a show dedicated to helping you not just survive retirement. Nah, we want you to rock retirement, even given today's markets. Welcome to the show. Enough with that stressful music, huh? We have week 2 of answering your questions on retirement, and I'm excited about that. But in our hot topic segment before, I'm also excited to talk about dealing with this idea, this thought that we all have, I understand it, that given today's markets, maybe we should change what we're doing. But we can't do any of that until we have that all-important disclaimer. So given today's markets, you definitely shouldn't take advice from me on this show. Really, you shouldn't take advice from anyone that you're listening to on the internet or reading blogs or anything else. Now, this is all grateful information. Hopefully, this is good information for you. But I don't know anything about you, so don't take advice from me, and I would never try to give you advice. I only give advice to clients. So before you make a decision, talk to your legal advisor, your tax advisor, your financial advisor, and realize this is just helpful hints and education. Now, let's go talk about today's markets. So in today's Hot Topic segment, I want to dive into this phrase that we use to preface almost any investment decision lately, and really it's for all time, and that is, yes, I want to invest in equities or get more conservative in bonds, but given this market, how do you think I should proceed? Somehow implying that, hey man, this is a time when we got to be really careful because, in this market, given this market and these conditions, we're at a perilous point in time where it could turn either way. That's sort of what that phrase is saying. And you know what? I actually agree with that. Given this market is a phrase we need to be saying all the time, but we have to acknowledge, hey, well, one, what market are we talking about when we say given this market? Traditionally here, we're talking about the S&P 500 or the stocks that it represents here in the United States, right? And so over the last 10 years, the S&P 500 has had an average annual return, this is up to June 30th, 2018, of about 10.17% per year. That's a good 10 years, right? Over the last 5 years, it's had an average annual return of just over 13.4% a year. Yeah, given that market where we've had this nice long run, that's pretty attractive. But that's just U.S. stocks. And we can argue whether they're overvalued or undervalued and the impact of the taxes and rising interest rates on valuations. I get all that. It definitely has been a good run, and things do cycle. But that's not the only equity market in the U.S. or in the world. So, just as an example, if we look at international stocks, which represents a huge portion of the global companies supplying global growth in the world, including in the U.S., over the last 10 years, the EFA index, which is the S&P 500 for international companies, over the last 10 years, it's had an average annual return of 2.84%. So it's drastically underperformed U.S. stocks for 10 years. So that market has really sort of sucked for the last 10 years, whereas the U.S. markets have been very strong. So what market are we talking about when we say given these markets? If we look at emerging markets where a lot of the growth globally is captured, well, you know what? Those markets have been really bad for the last 10 years too. The 10-year average on the international index that represents the emerging market, so these fast-growing countries of the world. Well, over the last 10 years, the emerging market index has an average return of 2.5% a year. Again, pretty bad. So given these markets, well, what market are we talking about? Are we talking about the U.S. stock market? Yeah, it's been on a great run. You do need to be concerned about valuations, but there are lots of other markets in the world that most people own if you're extremely well diversified. As an example, I had a meeting the other day with a client, and we had the conversation of given this market, and I gave them an x-ray of their entire portfolio, and only 26% of the portfolio was in U.S. equities. That was a pretty conservative portfolio, so the overall allocation to equities wasn't huge. But only 26% of the portfolio was in U.S. equities. They were much, much more diversified in other areas of the world and in other asset classes than they even realized. And that's something I have to keep reminding and diving into because we listen to the news cycle, right? We listen to what CNBC or Fox Business News or whatever your flavor is. And all we hear is how amazing the U.S. stock market has been, which it has, and how we're close to all-time highs and then all the crazy economic stuff that scare us. So the first question is, well, what market are you talking about? You got stocks, you got bonds, you got commodities, you got real estates. And then within even those asset classes, you have U.S., you have international, you have emerging markets. And then within all of that, you have small companies, medium companies, large companies. And then in all of that, you have value, more conservatively or, slower growers that maybe throw off lots of income. And then you have fast growers that are more growth oriented. So given what market? So the way we approach it, at least in our practice, is we try to be extremely diversified, which will mute when certain markets are hot, but it will also broaden the risk and allow us to participate in almost all the markets and hopefully try to target a risk reward profile that is appropriate for the retirement goals that we're actually trying to get towards. So that's one thing to think about when you think, given this market, well, what market are you talking about? And if you're super concentrated in any one market, well, maybe that's a problem. It's not a problem when things are good. So like in the U.S. stock market, a lot of people are very concentrated in U.S. stocks. And a lot of people are very concentrated in like the FANG type stocks, those fast growers that have been setting the world on fire, the Facebooks, the Googles, the Netflix. It feels really good when the party's going on, but things always cycle and then it feels really, really bad. Why try to time any of that? Get super diversified. Another area when we think about these markets are tariffs, the national debt, interest rate cycles, and things like that. And those are important. And I'm not saying don't pay attention to them, but this is a sign of me feeling older. If you've been around long enough, you sort of heard this story over and over again. Now, I wasn't around for the 70s as far as investing was concerned. But in the 70s, I can imagine when you had a market that had been hot for 15 years through the 60s, all of a sudden collapse and you get into those bear markets of the early 70s. And then you have the embargo on oil and then you have inflation starting to spike. Man, given those markets, how could you invest? It actually ended up being a pretty good time to. And then you get into the 80s and you had inflation, massive inflation that was being fought by Paul Volcker that was never going to go away. And how do you invest in those markets? And then when I entered the scene from a professional, then you had the 90s. And I remember in the early 90s, 87 was still fresh. And you had massive corporate layoffs. And some major companies like IBM and others were really not in their sweet spot. They were struggling at the time. You had the massive run-up in technology in the 90s. And in 1999, the conversation of given these markets was, how could you ever own real estate or value companies? It was all growth all the time because we were in the new economy. So given those markets, why would you ever own value managers or things that were super diversified? The party was over there. And then 2002, what was it? Well, stocks sucked. So given those markets, why even bother? And then 2007, I'm just thinking through these, 2007 was the housing market, right? Man, just flip away. Easy money. Silly to buy stocks or anything else. Just go buy houses. Real estate's where it's at. And then in late 2007, maybe 2008, I get these numbers wrong in my head, peak oil and the whole dynamics around peak oil. And then 2009, I'll be happy if I got a job. And forget about investing. And then really from 2009 to 2018, the attitude had been George Sanford, which is, the big one's coming right around the corner. There's always, given these markets, that is always going to be there. And we're always going to feel worried and afraid about things we can't control. It doesn't mean that you just forget about it and close your eyes and just bet and hope it works out. No, you got to be prudent about it. You got to focus on having, in my mind, an agile practice and managing your balance sheet, not just simply your investments. And within your investments, you want to know what kind of life you want to live in retirement, because you want to try to focus on, as best you can, getting to the minimum effective dose of risk and knowing what that is so you don't take undue risk, because you're likely going to need some growth and some income given how long you'll probably live. And you're going to want to be agile enough to keep reiterating so you can pay attention to what's going on and lean away from overpriced assets and towards underpriced assets in a prudent way, not in a trading way, and then keep making little adjustments along the way. And a lot of that is acknowledging that we're never going to be safe. We're never going to have a clear vision out of our windshield so we can see a nice, smooth path ahead. We're never going to have that. That means we've got to have both hands on the wheel, not drive scared, but be alert and make little adjustments so you don't get yourself into trouble. Just want to give some perspective to that, because that's an attitude I think we see time and time again, regardless of what the markets are. With that, let's go get Nicole in here and answer some questions. So last week in our Happy Lab, we were talking about giving someone grace. Well, in this practical planning segment, we're going to get to a lot of listener questions, which we've gotten to already. But what happened, Nicole?
Somebody wasn't recording.
So I just got to receive some grace from Nicole, because I'm like, after a question or two, I guess it would be better if we recorded that. So we are doing listener. Yes, that is important if we want you to hear this. So we have more questions today, right, Nicole?
We do. We have more questions today. And our first one is from Todd. He writes in, and
wait, I'm getting like a deja vu moment. Just so
this should be deja vu. And there's so many pieces to this question. I hope that I repeat them all accurately again. So the first question is from Todd, who is 50 and his wife is 35. They have most of their retirement savings in an IRA and 401k and have a gross income of about $450,000 per year. He says they are maxing out their 401k contributions, and he's doing a catch-up option for people over 50. And also, he's putting more into a Roth than the 401k and contributing to the 401k after tax. He wants to know if he should be putting more into the Roth than the 401k. And he also wants to know, he's planning on using this for college expenses for his daughter, who's almost 2, and he wants to know what you think about that.
Well, Todd, that's like a meatloaf of a question. You got a lot of good stuff in there. I love meatloaf. All right. So first, I just want to ask a question, and maybe you can shoot me an email. You say that you have most of your assets in an IRA and a 401k, but you're contributing to a Roth, and I'm assuming that's an IRA, and you have income of over $450,000 a year. So be careful there, because you're not allowed to contribute to a Roth with that type of income. And if you're doing a backdoor Roth, and we've talked about that on the show before, so if you're over the normal income limits to contribute to a Roth, you can make a non-deductible contribution to an IRA and then convert that to a Roth. And that's a way of getting around those income limits. But if you have an IRA with other assets, that can really be problematic from a tax perspective. So I'm guessing you got that figured out, but I wanted to point that out if you don't. So I want to unpack this a little bit. Okay, you're maxing out your 401k, which is awesome. If you have a Roth option in your 401k, then I like more money going into your Roth option, even though you're 50, because the spread between you and your wife is such that, her longevity is going to be much longer than yours potentially. So this will be tax-free for an even longer period of time, assuming that it ultimately goes to her. You say that you're making after-tax contributions into the 401k. Now, I'll be honest, Todd, I am not really a big fan of that. It can create some complications when you're withdrawing the money if you don't keep accurate records. And I would much rather have that after-tax contributions going to after-tax investments. Because if you invest efficiently, you can take advantage of low capital gains rates, qualified dividends, and be very tax efficient, and that will help diversify your balance sheet even more. And I just did a video on this on our YouTube channel, youtube.com/retirement answer man. Go check it out. We'll have links to it in 6 Start Saturday. Anyway, back off the commercial, where I'm a big believer in diversifying your balance sheet, which a lot of people don't do. A lot of people just keep socking away in retirement accounts, which is awesome, but then they get into retirement and all their money is pre-tax. And now they have a lot less flexibility. You're not doing that because you're doing some Roth contributions, but I'd like to have after-tax assets. And I think you could take your after-tax 401k contributions and do this. You already said you got a bunch of tax-deferred assets, so you're doing well there. And then you're doing tax-free assets, your Roth. So I would, look at your balance sheet and think of it in those terms. Now, you mentioned your 2-year-old daughter, and you're planning on using some of this for her college education. And I'm assuming you mean 401k loans or Roth withdrawals. I'm not really a big fan of that. Your daughter is so young that it may make more sense to invest for her even on an after-tax basis on your balance sheet, or taking advantage of a 529 plan, because that's going to, she's 2 years old. You're going to have 16 plus years of potential growth, and all that growth will be tax-free if it comes out for qualified expenses. And if you plan on having another little one, you can always change the beneficiary of this 529 plan. You could actually change it back to yourself if you wanted. So I think you should take advantage of that. So there are some ideas and suggestions. That was good meatloaf.
Our next question is from Max. And he wrote in, I'm 59 and plan on retiring next year. I'm debt-free, financially independent, and my pension will cover living costs, but I'm looking for a source of travel and fun money. I have a second home that has a market value of about $1 million that I either want to rent or sell. I really don't want rental headaches, so if I sell, how would you recommend I invest the money if I want cash flow?
Well, you say you don't need the money. You don't need the cash flow. One, I get not wanting rental headaches. But there are, if you can find a really good quality property manager, you pay them to deal with all the headaches. So you could do one, you have something before you disrupt life and incur all the friction and costs of selling the property. Look at what the rental potential is, even with using a quality property manager. That would be the first step, because that might give you the cash flow you need without any headaches because you found a good quality manager. And that's just a task to go interview. If you do decide to sell it, then how do you invest the money for cash flow? Here's the hard part of answering that question, Max. I get lots of questions like that. Even, just being in the grocery store or at a party, I got this, where should I invest it? And be honest, I never answer the question. Everything I do is, because that's a tactical question, right? Where do I invest to get cash flow? Or where do I invest to get growth? That's a very tactical question. And it's a normal question because that's usually where our mind starts. The only way I answer that question with a client even, go through a well thought out process, which will give you an overall strategy, which will lead to the tactics. And I think that is the only way to go through this prudently to actually answer your question, because your balance sheet is unique to you. What you're trying to accomplish is unique to you. And only going through the process of identifying exactly what we're trying to accomplish, understanding the whole financial picture from a cash flow perspective, current, and from a net worth perspective, can you actually get to the tactics of what you actually do with the money? And if you go through the process, or if you go through that sequence, it's actually a pretty easy question to answer by the time you get down to the tactics. From an investment standpoint, you can go back. We did a series last summer, a whole month on investing and how to think of asset classes. And we did bonds earlier this month that you can go revisit to get some thoughts there. But, I really can't give you advice on how. I would never recommend anything to you because I haven't gone through the process to get to the strategy, to get to the tactics.
Our next question is from Chris. And he says, a question I haven't seen addressed so far is that we are contemplating using the gains from the sale of our current home when we retire towards a retirement home, but then hold back about $100,000 to purchase a small apartment in Italy that we would use as a summer home each year. We do not intend to use it for just a week or two here and there, or we would just do an Airbnb or something similar. It will be for 3 months a year, and it would also be something they give to their kids, as they would have a free place to stay if they're in Italy. He would appreciate any information that you can provide on why this is a good or bad idea. Thanks for any guidance.
Wow, that's cool, Chris. I've never been to Italy. Have you, Nicole?
I have not. My husband actually went earlier this summer with his family, though.
So I like the idea, assuming you do the legwork, right? So it sounds like you can afford to buy your home outright and just hold back $100,000 for a small apartment. I think the way you would go about evaluating that is obviously you got to go through the process, strategy, tactics. But, how do you evaluate whether to buy an apartment or not? Well, one is it could just be a use asset. And it sounds for you that this is an asset in a different country that you would use, say 3 months out of a year, which is a good period of time. And you want to have it available for your children. So that use aspect is important and it has to be part of the equation. From a financial aspect, the key is, can you afford $100,000 being in a use asset and not handicap the rest of your life or retirement? Based on how you word the question, I'm thinking that you probably can. You're going to want to make sure you understand the legalities of owning a property in Italy, which I have no clue. That may be an opportunity to have it owned in a family limited partnership or a trust or a living trust, something that helps deal from a tax perspective so it all doesn't come back down to your personal return, because that can be problematic. I think that's a good idea if you have properties in different states. It just helps. I think the pitfalls are going to be the normal pitfalls that you would have if you had a property in a different state here. Who's going to take care of it when you're gone? Who's going to be the handyman? With the complication of taxes and whatever the rules are in Italy. But if it's not going to impair your life financially, then the use value of it sounds like it's pretty powerful. So I say do the analysis, but I don't see any huge pitfalls assuming you can afford it. As long as you
invite us.
I am.
Our next question is from Karen. And she writes in, when is it an all right time to take Social Security early? I'm 62, my husband is 63, and he just lost his job due to reorganization. I have already put in my retirement notice. We had a 5-year plan to live on his salary, and that just exploded. So we need to decide whether we should file now and tap into a bit of savings, or wait to file for Social Security and tap savings for all of their needs, or just look for jobs now. Any tips?
First off, Karen, I'm sorry. That's got to be a little stressful. So deep breath, okay? That's got to be a little stressful after 18 years to have a reorganization right at really an inopportune time. So how do you make this decision on whether to take it early? Now, first off, I would go back and listen 2 weeks ago to my talk with Devin Carroll, where we talked a little bit about when is a good time to take Social Security early. Usually, one, if you need the money and you don't think you're ever going to work again, is a good reason. 2 is if you're worried about longevity on either you or both of you. You don't think you're going to live long enough to get the value of waiting. And then another one is just to bridge the gap, to try to plug the holes, which seems to be where you're thinking from, is you're trying to do triage of how do we make all this work. Now, as important as that is, there's 2 things I want you to consider. One is it's not just about plugging the holes today, but it's also about the survivor benefit, assuming that his benefit is a lot higher than yours. And that may not be the case. I don't have enough information to tell. Because if you take it early, that's going to permanently impair the survivor benefit as well. So you got to think from a stewardship standpoint. And he was planning on working to bridge the gap. My challenge would be, what could both of you do from a pre-retirement standpoint to bridge that gap? So if your Social Security now is going to yield $36,800 a year rather than a little over 48 if you waited to 70, well, what could the two of you do to make $37,000 a year that would still give him more time freedom, maybe more time freedom than he had in his career? I don't know, because I think that's going to be very powerful in, one, preserving your assets, which you're going to need, because if you're age 60, you're a little over 60, but if you're age 60, you still got a 50-50 chance of living over 90. So we got a long time frame here. 2, it will help him find purpose, because he just lost his job unexpectedly. There was a 5-year plan. He may not know what the heck he would do in retirement anyway. He or you both may need some purpose. So you might have, I think this is a perfect opportunity to do some pre-retirement, figure out how the two of you individually or together can make 36, 37, which will help preserve your assets and also help preserve growing this benefit. So you're not just taking care of today, but you're taking care of tomorrow as well. So that would be my counsel. So sorry this happened to you, but I think you have a lot of options. So I would suggest you think creatively rather than a quick fix. Well, on that happy note, I feel bad for them. Let's go get happy a little bit. Let's noodle on how to be happy. Nicole, it's a little hard to noodle on how to be happy with what Karen and her husband are dealing with. So here's my thought. And I think, we all have these kind of moments. It's just different versions. And we've talked about this in the past. Is a good friend of mine, Dan Miller, one of his favorite questions is, what does this make possible? When something unexpected or bad happens, as soon as you can, start asking yourself, what does this make possible that I didn't even consider before?
That's a good point. But I remember you telling me something once when I was going through an unhappy moment to let myself feel it first. And I think that's important advice. Yes,
there's definitely, we'll call it a period of grief that you don't need to stuff down, right? And right. I think Karen and her husband, that would be shocking. It was like, holy cow, what do we do now? And fear, sadness, maybe despair, depending on the person. That all is all part of it, right? You got to have all that. But then, that's like being on your heels. It's like when you get pushed, you get back on your heels. And then it sounds like they got pushed back on their heels a little bit, right? Big time.
Right.
At a vulnerable period of life. So you got to acknowledge that, like you said, own it. But then you got to get back on your toes. And really asking, what does this make possible, get you back on your toes, get you proactive. Because all about creating a great life is just how you're dealing with things and how do you take intentional steps to, better yourself and better your life. So my thought is, like, what does this make possible? And I'm just guessing here. Well, maybe this is going to give him the chance to work a lot less hard and have a little bit more time freedom. And even though he's out of his career, he can still make a little bit of money. So I hope that helps. And I think once you start to get on your heels, once you get through that and start to think proactively, what does this make possible? It empowers you. And that's a good way of starting to take control and be happy again.
On your marks, get set.
So in the next 7 days in this Smart Sprint, what I want you to do is take a little baby step to creating a great life. Now, we've been getting a lot of comments about having more community and walking life and being able to speak into each other's life, because really everybody that's on this podcast or listens, they're all walking a very similar journey. So we are considering building something that will give more in-depth education and resources for you to rock retirement, and also give you a chance to have some community so you can share ideas together. But we don't want to do it if it's not something you have an interest in. So on your next 7 days, you're going to get an email with a quick survey describing what we're thinking about doing. And if we have enough buy-in of people that says, yeah, that's interesting, and I would be attracted to that, and it would be helpful, then we'll build it. So in the next 7 days, respond to that email if you're on 6 Shot Saturday so we can work at serving you better and helping you rock retirement. Hey, Nicole.
Hey, Roger.
Do you know what I have in my Retirement Answer Man World Headquarters?
A picture of Winston Churchill.
I do.
A giant R.
A giant R.
Sometimes Sherlock.
Sometimes Sherlock. If you don't know who Sherlock is, go to our YouTube channel and you'll see him here and there. He hangs out. He's our Great Dane, who is awesome. But I also still have, believe it or not, boxes of books.
Still?
Yeah.
Wow.
Well, I ordered like 5,000 of them.
That's true.
to give them away. And when I go speak at events, I went and spoke at a few. I gave away a few, about 300, 400.
Did you sign them all?
I did not. I did not. But if you want a free signed edition of Rock Retirement, which people seem to like, which is cool, if you buy the Kindle version, which is like $6, read it, and if you leave an honest review, I can take it, but be kind. and let us know that you did that, we will send you a free signed paperback book to treasure always.
I treasure mine.
No, yeah, you're paid to treasure yours. So if you want one, that's how you can get one for free. But anyway, next week we got more questions. Hope you're having a cool August, and we'll talk next week.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.